Investor sentiment is slipping. New report from John Burns Research and Consulting, as well as Berkadia, talking about investment sentiment for commercial real estate. We're going to take a deep dive into multifamily, but also we're going to be taking a look at the single family home market, how sales have increased. There are more sellers than buyers. How is that impacting the overall housing market? And maybe are there some impacts to multifamily as well? Maybe a little bit of hint of what's to come. And then also looking at the convergence of occupancies between A-class properties, B and C-class properties. Those spreads are tightening. Why is that? What could it mean for other asset classes? And we're going to examine the relationship between A, B, and C-class assets. It's going to be a great episode. Get ready, strap in, let's do it. Welcome back to the Gray Report. My name is Spencer Gray. I'm the president and CEO of Gray Capital, multifamily investment firm located in Indianapolis, Indiana. I'm joined once again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital and producer of the Gray Report. Matt, how are things going back in the Midwest, back in Indianapolis?
Pretty good. We miss you. Come back soon.
I miss you guys. I'll be back soon.
Yeah. Good. No, it's been
Next week I'll be in the chair.
Oh, good. We'll all breathe a collective sigh of relief, but it's been really exciting. Even with you gone, I'm sure that you've been informed of some exciting stuff that just keeps happening at Gray Capital. So that's really nice.
I don't know anything that's going on. What's happening? What's exciting? What's happened? Well, give me and the viewers an update. Like, Spencer, I don't know. Maybe I don't.
At this point, I'm glad that we can edit this out, because if I'm mistaken, I just will edit it out. I think that we may have a new deal in the offing, so that's kind of exciting. Although I don't know what the specific scuttlebutt is.
Don't want to let the cat out of the bag, but we've got some stuff cooking. We can say that, some exciting stuff, and I think it's counter to some of the research and reports we're going to be talking about today. But it's what's gotten me kind of excited, because I think that there's some clarity in the long-term data and the fundamentals of where we're going to be in maybe 2-3 years. In terms of, are people still going to be living in apartments? Absolutely. Yep. But the short term is highly uncertain. When we talked last week about, conflict in the Middle East, and things certainly have been kind of ratcheted up since then. Sort of don't even want to talk about all the details, because things will change dramatically by the time this episode gets posted. But uncertainty has not gone away, to say the least. But again, while that can lead to a slowdown in investment sentiment and some renters not being able to decide where they're going to move and make those big financial decisions, I mean, the bottom line, if you're looking over kind of a 5-7 year period, we're not going to have built enough housing. And getting in now when others are on the sideline, I think this, again, this 2025 vintage, 2026 is going to be a great time to be buying multifamily if you have the ability to form the capital stack to be able to do it. That's the challenge right now.
You can totally see in a lot of this investor sentiment survey a little bit of a lag, a little bit of a sign of like, all right, a turn from kind of uncertainty into something different. I think there's going to be a different environment in 25 and 26 and at the end of this year, and you see hints of it in that people are expecting some pickup by the end of the year. I don't know how much that's going to be, but I think that it is worth noting how regional this recovery and the investment feasibility, I think, is going to be, because there's still going to be pain in the Sun Belt in some of these Avis and Young calls them lifestyle markets, but then there's other places that aren't even gateway markets that are maybe in the Midwest that haven't seen the supply, and that's going to pick up a lot more, and it may not show up in the investor sentiment surveys because they're all thinking of gateway markets and the Sun Belt. So there are opportunities out there, and I think that there are places that are currently doing quite well in the multifamily market, and these are just whole markets on average. That's not even just to say, like, there are probably specific properties and specific submarkets that are performing well now. So it's not as if it is a wholly dark and dismal environment. It's not a bleak landscape in multifamily. I would say among all the sectors, because this surveys from John Burns and Berkadia and Avis and Young, they will mention other sectors. Man, multifamily looks good compared to industrial, retail, and office, of course. So there's reasons to be confident.
Yeah. Well, and multifamily is resilient, for downturns. And if you're looking for a safety trade, as we've seen, some movement into the 10-year treasury, some prices increase, yields go down slightly, not in a big way, but we're down kind of in the 4.33% range, 4.3%. For the same reasons, people are going to be flocking to something that's stable, like multifamily. So again, it's not like it's smooth sailing ahead, but there's a little bit more confidence going to those safer asset classes. And one thing for sure that I feel confident in is that we will see some activity later on in the year. There's going to be more properties that are going to be on the market. What we don't know is where they will trade, and if that will be a little bit of a weather vane in terms of where the market is going. If there are buyers at relatively, call it lower cap rates, I'm talking not necessarily sub 5% cap rates, but if we're seeing acquisitions in the 5% cap rate range, plus or minus 25 bips, that's going to indicate that there's a strong appetite for multifamily assets. Now, if we see not a lot of buyers show up because of so much uncertainty or a lack of confidence, and we see the majority of those transactions take place in the closer to the 6% cap rate range or higher, that's essentially confirming another leg down in valuations. But we have to see some more price discovery before we could really decide and see a clear direction and path. So the question is, do you jump in now and acquire something at, let's say, a 5.5 or 5, just a sub 6% cap rate, before you have all that information? Because if we do see those transactions to lower cap rates, that means the cap rates could even see further compression, as it'll be a confirmation trade. More investors will start piling in, and the FOMO trade will start to occur of, well, we need to start playing catch up, especially when institutions come in. Now, the opposite could be the case. If there's not very many buyers show up and those prices go down, cap rates go up, there could be a fire sale, because all of a sudden a lot of those banks and institutions that have said, we'll allow you to kick the can down the road, we'll allow you to extend those mortgages, there's going to be further equity loss, and all of a sudden those banks are going to see themselves having to take some haircuts because the valuation declines have been so heavy. And at that point, we could see some forced selling. My opinion, I think we're going to see more strength, because where are you going to put your money in this environment that's somewhat safe? But we don't know. So it'll be an interesting couple of months going into the end of the year.
Yeah, I think you hit the nail on the head there. I think that that if anything, some of these surveys kind of a little bit downplay the persistence of loan maturities and potential distress. However, that's not something that we're ready to ignore. And that's actually, there was a Globe Street article I didn't have time to include in this Gray report that talked about how non-bank funding and things like debt funds could lead to some shakiness, and there's a little bit more of a question mark over them, over these non-financial institutions doing the lending, and how that might affect the debt market in general. So there's there's some uncertainty over that and some worries on that. And I think there was a government organization that sent some note out that's like, worry about this. So I just thought that was particularly interesting.
Well, no, I saw that note as well, man. I actually brought up that exact same point when I was speaking at a markets group, the real estate conference up in Chicago just several weeks ago, and I was asked, what are some of the risks that are on the horizon? And I brought up loan maturities, but the other risk that I saw in the market that I think that many have just discounted is all of this private credit and preferred equity that has been deployed over the last several years. investors, especially high net worth investors, RIAs, family offices, and institutions have flocked to moving up the capital stack away from common equity into preferred equity or private credit. Part of this is, Dodd-Frank made it harder for banks to issue certain types of loans. And so it's the creation of all of these private non-bank lenders, as you were describing. And a lot of investors don't exactly understand the risk they're getting themselves into. Yeah. They're searching for income and yield because, especially clients of RIAs, registered investment advisors, a lot of their clients, are older and they're looking to supplement their income or they're looking for income sources. They're not necessarily looking for growth. Think about all the baby boomers that are out there. Yeah. They're living off those dividends. Yeah. And as, they're no longer get the 8% cash on cash you might have been able to get out of real estate a couple of years ago, they're seeking alternatives. And then when someone says, hey, I can get you an 8 to 12% cash on cash, and maybe you're going to take a little bit lower risk because you're going to move up into the capital stack right behind the senior note holder, that sounds like a really good deal. The problem is, even though that you're in a better position than the common equity, the deals that pref equity has gone to, many of those deals have been bad deals, really ugly, low quality assets. And because we were looking at launching a prep equity fund, if you go back during 2020, at the end of 2023 into 2024, seeing this, and we scoured and looked at tons of deals. And Matt, you saw they were garbage deals.
The people that were
we
calling
made a
us,
decision.
Our like, phones were ringing off the hook, but there were people that were like, "Hey, my shed's falling down," that kind of thing. Like, oh man,
it was plenty of opportunities to throw good after bad. And here's the other thing: these groups, they're making their money on fees. You have to do volume to make money in that business of providing private credit and pref equity. So they're doing transactions, volumes of deals. It was the only way that we were going to make money. The challenge was we couldn't find any deals worth putting money into. And so we're never going to be able to do the volume. It's not worth it. Well, the demand is there so strong from, again, wealth managers, RIAs, to say we need to find income for our clients.
Interesting.
And so that, they weren't, they were able to underwrite kind of a strategy and a thesis and feel, comfort being elevated in the capital stack, but weren't able to fully underwrite, in many cases, certainly not all, the actual risk of the underlying asset.
Yeah.
And so again, I think that there were a lot of good money thrown after bad, and people thought that they were going to get a free lunch by getting a 8 to 12, even 14% return without taking on any additional risk. But any listener or viewer of the Gray Report knows that you can't get that kind of reward without taking on an equal amount of risk. Yeah. And I think that a lot of folks have put their head in the sand, unfortunately. So I'm not saying that it will absolutely come to pass and that's going to be an issue, but it's something that should be on the board. And it could be a catalyst because there's been a lot of money chasing private credit over the last several years. And then, preferred equity, private credit, especially over the last few years when, hey, a bank's only going to give you 60% loan to value. You can't raise all that equity. Well, you go and bring in some prep equity for the other, call it 15% or so of your capital stack, make the deal work on paper, but in paper only. So yeah, let's watch out for that.
Yeah, for sure.
We should do a whole thing on that, by the way, Matt. I'm glad you brought it up. Not to distract from from the John Burns and Berkadia Madison young piece.
It is an interesting. I think something that is interesting is happening under the surface here with loan maturities and with the fact that, and you'll see in these surveys that we're about to talk about, investors are inherently hopeful. I don't think that they're ready to jump into the water if their boat is sinking. I think that they will run that ship into the ground, or they will sink with the ship before they tell anyone about it. That's kind of what I'm thinking is the troubled borrower, and he's going to look for all these options before you kind of really see the full extent of what the damage might be. So that's and I would pay attention to the space and see something happening because it could be sudden and it may not be wholly transformative, but these problems are not going away. And there's also recent data from TREP and CredIQ showing delinquencies are back on the rise as well. So that's it's a story that's still playing out, and it's a story that has not gone away and will not. At least not in 25. Maybe 26 will save them.
see.
Yeah. I want to get into this fear and greed survey that I've hinted at. It is John Burns Research and Consulting. I'd like to give a little bit of an overview, and then we'll see what you think of it.
Let's do it.
So John Burns and CRE Daily both kind of pool in together, and they have released their fear and greed survey for the second quarter of 2025. A little bit shakier, seemingly, than one might expect, considering we've seen some. It hasn't been doom and gloom on the headlines yet, but there's a little bit of fear, but still. The fear and greed index is 56 out of 100, so that indicates an expanding commercial real estate market, but still,
just barely, right, Matt?
But just barely, yeah, just barely. And I will caveat this whole discussion where unless the environment is clearly bad and it's like hard not to notice that things are going down, I think that all of these investors are inherently going to be positive. They're going to be confident. They're going to say, in a year, 6 months, things are going to pick up. I expect to invest more. That's the default, I think. And so you have to read between the lines a little bit of the levels of high confidence. And so maybe are they a little bit less confident this quarter than last quarter? And so I just want to read it through that lens. So through that lens, it doesn't look like we are improving or we're getting that much more confident than we were last quarter. We went from 55, that was our fear and greed, to 56, still in this like kind of stagnant area. And when it comes to people that are thinking about increasing or decreasing their exposure, only 56% say that they plan to increase their exposure. Now below that, it would be decreasing. So that's kind of how that scale works. I think that is very notable because 56 is not far off of where it was. It's exactly the same as what it was in Q4 2024, not far off from where it was in Q1 2024, which was 53. So the market hasn't really changed, and it hasn't changed from a point where it was really slow. So they do think in the next 6 months they're going to change, but they haven't really. No one's going out in there and buying, partly because, as it says here, the access to capital is pretty tough right now. It is. So this is a personal. I was wrong. I thought that maybe it'd be easier to access capital this year than last year, but it's only marginally so. So last year, the access to capital with 100 being good, 0 being bad. Last year was at like 33, 37. Now we're at 38 and 39. Hardly a good environment for people that want to get investors. And I think that reflects the continuing uncertainty. It's only slightly better, and that better is still pretty bad. Not wholly bad, but just a little more depressing than a sobering read is how I would assess it.
Now, without a doubt, capital's hard to access. It's been hard to access the last couple of years, but my takeaway is from whether you're taking over the overall index or the access to capital is that there is a somewhat positive trend line. I mean, again, yeah. Access to capital down at 39, 50 is typical. It's very difficult right now. But the fact that there is we've seen a trend of positive of interest further to that greed spectrum over the last several quarters is a good indication. Same with access to capital. It was down at 25 level in the first quarter of 2024. It's up to 39. Again, it's not great, but we're moving in the right direction. The one note I'll make on this survey is I think that all of this was done. I think the date is May 2025. Okay. It was published in June 25, before the Israel and Iran conflict. Yeah. Again, it's maybe blown over in a couple of days. In a week, it may be really bad in a week. So we don't know. I'm curious how this is affecting investor sentiment, if at all. I can't imagine uncertainty will dramatically increase investor sentiment, unless there's this idea, again, of flock to safety and folks saying, look, I don't see how this conflict in the Middle East is going to affect commercial real estate necessarily. And with the 10-year Treasury, if there is a flight to safety, that will show up in U.S. Treasuries as a safe haven investment. People don't want to necessarily allocate to risk assets. But then there's also the question of, potential inflation, the closing the Strait of Hormuz. So again, I'm curious that if the survey was taken after the conflict had started, if it would be the same. I think a lot of investors, I'm just thinking, again, using like my own thoughts as potential anecdotes and for other investors and trying to extrapolate. I mean, if you are like me and you believe that there's a long-term opportunity and the fundamentals for the long term make a lot of sense, you would be seeing this as an opportunity to make opportunistic acquisitions.
Yeah.
Other investors, especially institutions, are going to use it as an opportunity to say, we're going to move back to the sideline. We're going to stay in bonds and wait this thing out.
Well, and that's kind of what I was thinking too. And also, when it comes to access to capital, there were I don't think that we had a deal earlier that we were that we were considering raising, and we weren't running into huge roadblocks. I don't think that people were like,
We're special, man.
Yeah. I don't think that it was. Yeah,
kidding.
that could be more special. I think one thing that was special was the market, and some of the markets that people are excited about are not the markets in the Sun Belt, in kind of the gateway markets where people are kind of where the majority of the sentiment may be located. I just think that seeing how relatively easy it was to reach out to investors and get them kind of excited earlier this year, and then there was a similar deal that also was raised. Like, people are raising money is my point, and the people the deals that I can see, that are reported, and the excitement from people that have closed these deals, it's not, this is not a dry market, a completely empty market, and I think especially in the Midwest there's something to get excited about, and there's something to be certain about, and that's another thing that I wanted to note too. Is sure, it may be it may be a little bit uncertain, a little bit pessimistic, but if you're thinking that there's going to be a recovery in the market, you want something that will perform now, that is stable, and it's not like a totally risky asset, and you want something that maybe will pop up afterward. And if you're betting it all on things recovering, but you're going to bet in a very risky place, I don't think I want to take that bet. But if you want to invest in a more stable market that's doing okay anyways, that's actually not in trouble, then I don't see where else to put your money, especially if it's an uncertain environment. I just think
you make a great point, Matt. No, I think it's a great point. And again, it comes back to nuance. It's a very nuanced market. It's a very bifurcated market. We're going to talk about the single family home market later on, and it's going to be the exact same story. And so if you are still looking to, remain in commercial real estate, you are looking, okay, where can I be a little bit more confident? And the Sun Belt, again, I think you can be confident over a longer term horizon, but I think it's still volatile. The prices, the rent growth is still negative. It's much harder to make deals pencil when you are experiencing negative rent growth and not a lot of confidence that you'll absolutely see positive rent growth for another year or two. If you have again, it's simple math, 0% growth or negative growth for a year, it's really hard to compound out of that and grow out of that, especially if you're using negative leverage to acquire the asset. You really have to be able to grow out of it if you are going to do that. Mm-hmm. But in the Midwest, or even in some of the primary markets in like the Northeast, you're seeing positive rent growth. You've had positive rent growth. The supply situation is much more balanced, much less supply. You can be much more confident that you can buy that asset and out of the gate get some strong yields and income with the ability to grow those rents and net operating income over time. So I agree. It just, there are some investors that will understand that nuance and some that will miss it completely, painting with a broad brush. Yep. Again, I think this comes back to that's where the opportunity is. If you are willing to take the extra few steps and be able to identify the differences between regions, markets, and then even submarkets, then you're going to find some really killer opportunities, unless you just think that multifamily is going to absolutely crash in the next year and you're just going to try to time the market for that opportunity. But that's going to take a lot more intuition and capital ready to go to be able to execute on that thesis than just trying to buy right for the fundamentals for the long term.
Yeah. Speaking of value, so they have so this John Burns and CRE Daily, it covers industrial, office, retail, and multifamily, and they do see some change in the values of these assets, and not necessarily to the benefit of multifamily. Now, I'll just bring up the line graph because I think it looks nicer. They've got retail as the only one that's gaining, which is it's gained 1% in its values from Q1 to Q2 2025. I'm sorry, this is a year over year increase. So industrial is flat year over year. Multifamily has decreased by 6%. 4% year over year, and office has decreased by 10% year over year. I don't think that this is because multifamily is just as bad as office. I think that it is because probably multifamily had an incredible rise that everyone should probably remember in like 2021 and 2022, and now this is a kind of extended recovery. It is -6 year over year, and last quarter was -7 year over year. So there is a trending upward, but it is still it's still decreasing. There's still an argument to be made that it has yet to bottom. I think that this is going to be a case by case thing, a market by market trend, and you're not going to be able to pinpoint that exactly. Some sources last year said that the multifamily market has already bottomed. So I'm not sure if this is completely reflective, because also this is representative of a survey and not necessarily a scientific objective recording of the values.
I was going to say, yeah, this is not actual transaction data. This is opinion of values, which is interesting. But I think it, again, anecdotally from my vantage point, you are seeing deals that are trading at pretty deep discounts, and there are some distressed sales and stuff being taken over, not wholesale everywhere by any means, but especially in the Sun Belt, where again multiple years of negative rent growth, expense growth, and cap rate expansion. That'll put a deal down, and you do have owners that are just handing the keys back, whether to the bank or they're just handing them over to the next buyer, and they're taking big losses. Equity is being wiped out.
Yeah.
So,
and so
I can see why the survey says that.
Yeah, and also when it comes to their expectations, it's kind of interesting. Their expected change of values is last quarter they thought that values would be in the next 6 months would be flat, and now they're thinking maybe it will go down by 1% for multifamily. For industrial, the survey respondents are expecting a 1% increase. Retail flat, and office is a -4 change, so 4% decrease. I still think that we're kind of within the margin of error for multifamily, and I think a lot is going to come out of this increased sales activity that a lot of people are hoping for, me among them. Now, this is just a side question. When it comes to sales activity, does it normally pick up in the second half of the year, or is the first half usually the busier time of year when it comes to buying and selling multifamily?
There is often a surge of transactions at the end of the year. I mean, if you think about, some deals begin at the beginning of the year. Some of those deals maybe take 90 to 120 days to get done. So certainly in Q2 there is a spike in transactions, but then in Q4, people trying to get deals done prior to the end of the year. There is quite a bit of a spike in Q4, and I would anticipate that would be the same case this year as well. I mean, we could see a pickup in Q3, but I think that the vast majority of volume will be in Q4.
Yeah. Okay. I just want to skip here. This is one of the headlines of the report, which is that 71% of commercial real estate investors are holding tight in Q2 2025, the highest in the survey's history. It is a 5% increase in the amount of people that are holding off. I think that that is still a far cry from the 47% of wait and seers in Q4 2023. If anything, I just think that this is a continuation of 2024, and it is just like a lot of people are still waiting it out. Whether it is interest rates or tariffs, people are saying that it's uncertainty in tariffs, but I think a lot of it is interest rates as well. If interest rates are low, it would be tariffs would be less of a concern. That's all I have to say. It's kind of exposed people looking.
Well, I think people are over tariffs right now, just because there's not a lot of data that's showing that there's been a huge negative effect to the economy. Even certainly some more could come out. Looks like the margins for corporations are being squeezed, not necessarily being passed on to consumers, not as inflationary. But who knows? We still have time to let that data seep in. But again, looking back at these surveys, Matt, I mean, I think the path of interest rates are still a huge factor, which obviously they impact valuations,
Yeah.
risk-free rate, and all that. But the third quarter of 2024, I mean, we had the idea that, or the survey indicates that there might be a 3% increase in values. Well, the narrative at that point in time was that we would absolutely, without a doubt, see lower interest rate in 2025.
Yeah.
Survive till 2025 was the mantra. Q4 of 2024, maybe a little bit decline. They hadn't come down just yet. Then the first quarter of 2025, I think that there was a lot of hope that there'd be a really strong leasing season that would take place. We've seen an okay leasing season, but much more like 2024, nothing that special, relatively subdued uncertainty. And so because we didn't get that lift, again, we're saying, the investors are saying there might be a modest decline. We haven't seen rate relief. We're not getting the rent growth. And then there's just all this uncertainty. Why would someone say, yeah, no, I'm going to see values come up in the short term? Next 6 months is what it's asking about, right?
Yeah. That is a telling increase, that 3% from Q2 2024 to Q3 2024. It went from -2 was the expectation of prices, and then at 1 quarter later, +3%. That's a big jump, and I think it's directly reflective of that moment where we thought maybe interest rates were going to come down. I want to skip ahead to foreign investors. So that is the other part of the headline that they had for this survey, was that 52% of CRE investors report that foreign capital is reducing willingness to invest in U.S. CRE assets compared to 2024. This is interesting. It says they are modestly shrinking their exposure. There are some that want to modestly expand or significantly expand U.S. exposure, but it is a clear plurality. This 42% that are thinking to modestly shrink, and then there's 10% that are going to significantly shrink. So that is 52%. They're not as thrilled at investing in the United States. I wonder if it is associated with a specific asset class, but it's hard not to see that this could maybe affect kind of an across the board thing. I don't know if this is trade policy or if this is uncertainty or what it is. But it's a little bit dispiriting. This is part of the sobering this sobering read that I had.
I think this is a much more broad-based.
Yeah.
I think this is much more broad-based rather than any specific, asset class, multifamily, industrial, office. I think that this is, again, the survey was taken in May, even though we were past some of the kind of the worst tariff fears. I think that tariffs were on the mind for international investors. I think a souring taste for U.S. assets, looking for alternatives. And again, this is a survey. And so, if you've asked somebody kind of what their opinion, what their gut is, they're going to say, yeah, no, we don't want anything to do with the United States right now. We're going to kind of pause for a minute. Foreign investors aren't, they're not, they are important. They're not going to make or break the market one way or the other, but they certainly can move the needle a little bit.
Yeah.
And I'm interested again after the last several weeks if there's any change. Probably not from foreign investors. I don't think that they're, unless again they see the safety trade, which some will want to get into, safer assets. Stable coins are going to be interesting, with some of the new stable coin deregulation that has taken place, and whether some foreign investors shift to, moving some of those short-term funds into stable coins that are kind of denominated in dollars rather than buying treasuries.
Yeah.
But it's a lot of this is, to be frank, Matt, I don't think nobody really knows.
Yeah.
You have to have your own kind of assessment and thesis and take action accordingly. I think that there's a lot of noise, and some of this I think is noise. It's good to understand it, but I think that there's a lot of confused investors, and just because they're a big institution, their names on the side of the building, they're wearing a suit, doesn't mean they know what's going on.
Yeah, yeah. Valuation worries have maybe dampened enthusiasm. I think if the market increases and it makes sense for foreign investors and for domestic investors, they will come to the table. I don't think their feelings will be hurt if they can make
I'm
a little
not.
bit more money.
Yeah.
For
Long term, I think that those investors are going to return to the U.S.
Yeah.
because they're not going to be able to find the alternatives that they seek. But in the short term, it could be somewhat impactful.
Yeah. For all sectors surveyed, more of them expected that recent trade policy will have a negative impact than a positive one. But multifamily squeaked by at 52%, industrial at 54% negative, but also had the largest group of people expecting a positive impact, which was 29%. Still didn't tip the scales in the favor of these new policies, but was interesting that this must have been when these trade policies were fairly fresh, because a lot of people had a sharply negative take on it, and I would put myself in the neutral position. I don't know if it's going to have that much of an impact. At least at the moment, I don't know. I don't know what's going to happen next.
Yeah, if you would have told all these individuals like, "Hey, look, tariffs aren't going to have that big of an impact," would you say the same thing? And some would have probably changed their response. Now he followed up saying, "Oh, but by the way, there's going to be a major war in the Middle East between Iran and Israel, and the U.S. is getting involved." Again, this survey becomes even less meaningful.
Yeah.
But it's what we've got.
Retail obviously had the biggest proportion of expectations for negative impacts at 64%, industrial 54, multifamily 52, office 55, and average was 56. But again, like the 29% industrial, I think that's particularly interesting because you could probably slice industrial up and have a lot different assets. There's a lot of variation within industrial, and I bet some of them are pretty happy that maybe like steel or something, or some kind of an American, the shift for American manufacturing could really benefit them well. There probably are other industrial asset holders that are like, well, we've got to source all these things from these different places, and that may have a negative impact. So I think it's probably a huge case by case basis for that.
Agreed. Yeah.
Want to move to, this is Berkadia's mid-year multifamily investor pulse survey, and they're talking about how emerging trends are impacting investor sentiment at the mid-year. And I thought this was a great pair for the John Burns and CRE Daily survey. This is the Multifamily Investor Pulse survey, which was conducted in April of 2025, and it is the overwhelming.
Throw it out.
Yeah. The overwhelming majority of responses represented principal or executive level investors at both private and institutional companies. It's a couple months old, but I still think that it is fresh enough where I'd like to talk about it.
I'm screwing with you, Matt. No, let's look at it.
Yeah. Everything's different every month.
But again, it's still important. It's a data point, and it's good to understand the trend and the data point. I mean, again, the survey could have come out last week, and its usefulness would be already diminished, but it doesn't matter.
And think about how fresh Liberation Day or this kind of trade policy could be happening. See, look, Berkadia conducted this survey shortly after Liberation Day, and that is probably why 45% of the investor respondents had a somewhat negative response to the volatility that resulted from Liberation Day. So the question was, how has the volatility changed your investment outlook? 45%, it's somewhat negative. 32 says it's unchanged, and the rest is kind of mixed between very negative and slightly negative and somewhat positive. 4% had it straight up positive, so it's not wholly negative. There are.
Confusing is what it is.
Yeah, and it is confusing, and I think that the way that these questions are phrased could color the responses. So, for instance, when it comes to deal activity, are you seeing more or less deal activity as a result of the current volatility? 50% said that they're seeing less. 33% says unchanged, and 17% says more. I think that, well, are we talking about the deals as a result of current volatility? Are we talking about deals period, because there's a little bit of wiggle room there. But this is actually, I think this is really interesting. And this gets to the point that I was thinking about where these asset holders, if they're having a troubled asset, I don't think that they are, I don't think there's much that is motivating them to ring the alarm bells. I don't think so. Are there any dispositions you had planned that you're putting on hold due to the current volatility? 74% said no. 26% said yes. This is, I think that this is interesting because people don't want to show their cards and show that they have something bad. And the fact they're like, no, we're not going to change anything. We're not going to get rid of anything sooner or later. Don't worry. Everything's going to be okay. There's a little bit of cloud over that. I think there's sometimes where these respondents will probably hold things a little closer to the vest than others. But that being said, they did expect transaction activity in 2025 to be higher than in 2024. That's runs a little bit counter to John Burns Research and Consulting that thought that maybe in transaction activity it has, at least in the past, been a little bit stable. So why I asked about the second half of 2025 is because taken together, Berkadia and John Burns paint a picture of a slow beginning of the year and a very, very active end of the year, almost like catching up for lost time at the end of 2025. And we'll have to see how that actually does pan out, because if the conditions are the same, I think the only thing that will really maybe be different is people kind of rushing to get things done and realizing and making decisions really quickly. I'll have to ask some other people in the acquisitions department, like, what is the psychology of this? Because it's not like the uncertainty is going to go away by the end of the year.
No, I said before, Matt, I think there's a lot of deals that will be coming to market near the end of the year.
Mm-hmm.
Will all of those deals transact? Will they find a buyer? We don't know, but there is going to be opportunities to transact near the end of the year. But also, if you look back at our report that we published on loan maturities, Matt,
Mm-hmm.
multifamily, that the beginning of that next wave, whether it materializes or whether it gets extended again. That wave really begins closer to the end of the year. So all of that tracks.
Yeah.
And I think there is going to be a rush to get deals done.
Yep. Yeah. Good point. They also had some comments I thought that were really interesting. I just want to read this first one. They asked respondents, what is your greatest challenge in 2025 given the current environment? They have an anonymous, these anonymous responses. And one said, understanding that the current year is neither 2008 nor 2020, we recognize that the circumstances are different and not necessarily in a positive way. Patience is required during this time. It is not the moment to pursue opportunities hastily. Instead, we should be aggressive only when everything aligns with conservative assumptions. Otherwise, it is likely that much better opportunities will arise closer to the end of the year. That kind of sums up what we were really assessing. If you kind of weigh these against each other, the John Burns and the Berkadia surveys, I think that it also reflects the people are willing to admit it is a little uncertain. They're not willing to say like, all right, we pencils down for the rest of the year. They're not going to walk away from everything. But I like that at least people are admitting things, and they're not saying, oh man, I'm so excited. The rest of the year is going to be great. We're super confident. We have a really great plan. It's more like, no. We have been chastened. We have been wary, only because, and this is my putting words in this person's mouth, only because the past 2 years have been so stagnant. So it's hard to get excited about the potential for another year of maybe shaky fundamentals and maybe an investment market that's not active enough.
But there's also two types of risks, Matt, that I want to talk about that the director of the private investment company could be talking about.
Mm-hmm.
There's one, the risk of doing a bad deal, right? You make incorrect or more aggressive assumptions than reality. The second risk is the risk to be able to raise and form the capital stack required to actually acquire the asset itself.
Yeah.
You may have a great deal of confidence in the asset itself, in the thesis, but you may not have confidence in the ability to raise the equity or the debt required to execute on it. I mean, that's what I'm seeing certainly in the development space. I mean, talking to many developers who are very bullish on projects that they have in their pipeline, that they have, entitled, ready to go, but they are not confident in putting the equity together, be able to actually get started working on those projects. And so they've already taken risk and been able to do that, some of that pre-development work. But in terms of the acquisition space, having to put earnest money down on an acquisition, if you don't have fully discretionary capital, there's a risk there of, am I going to be able to find the equity required? Can I raise the money to actually buy that property?
Yeah.
Some groups have fully discretional funds are ready to go, or they have, they know exactly where the money's going to come from. A lot of those existing equity sources maybe on the sidelines, maybe they've gone away, maybe they've changed. Maybe you're an operator that hasn't done that many great deals and you've been issuing capital calls, and so you're searching for new equity. So I think that there is a difference between lack of confidence in the market and lack of confidence in capital markets and the ability to raise that money.
Yeah, no, that's a really good point. And that helps to support us kind of talking about this idea of sentiment too, because the vibe of an investor is the difference between the investor and choosing to invest in something or not invest. I know a lot of it is due to spreadsheets and stuff, but you can't discount the feeling and the sentiment of these people and the amount of confidence that they have, which is kind of reflected in the John Burns and Berkadia articles, and as well in this Avis and Young one, which is a little bit briefer, at least the way that I'm going to cover it, the way that I'm planning on cover it. But it reflects similar sentiments as John Burns and Berkadia. Their overall outlook is mostly the same, a little bit down, 51% up. Again, like I am confident that these investors are by default confident. So the fact that we're only seeing 51%, I think is notable. Now, I don't have the historical values of Avis and Young's data to see if 51% was confident last year and the year before, what the norm is, but my guess is that it should be more like 60. But because of the uncertainty, it is slightly lower than normal. But that's just that is just my guess based on like what we've seen and usually on these investor surveys and their tendency towards more confidence than less. Where they see investment fundamentals trending for the remainder of 25. Loan defaults, they're middle of the road. And the same thing with cap rates. There is they may stay the same. The chance for cap rates to go higher is just as much for it to go lower. And the same thing with loan defaults. Now, I would put a little bit of a corrective on the loan defaults, but that's fine. This is Avis and Young's survey respondents and not the Gray report. Investment pricing, they're expecting to improve. Investor interest. Now, this is really notable. They have it really dialed up here, expecting a significant increase in investor interest during the remainder of 2025. Leasing fundamentals, concession packages, even rents, asking rents, and tenant prospectus, they're expecting higher, and also leasing velocity much higher. Now, that's just the overall take on the market. And so that includes industrial, retail, data centers, and healthcare, and office, and as well as multifamily. Now, developers, this is their focus here, and I know you just mentioned developers. They're thinking that cost and tariffs are some of the things that they're going to be most focused on. I wonder what the split between costs and tariffs are. If this is a special category that where last year it was just costs, but I do think it's interesting that that's top of mind for developers. We've got our intern right now working on some projects that are looking at softwood lumber and how maybe tariffs are going to impact that. And it's a big question too that I've been speaking with him and with other members of the team about. What is the chief cost? Are there any kind of yardsticks that we can look at where we can see that, oh man, the replacement cost of multifamily has jumped 10%. Maybe it's softwood lumber, maybe it's a little bit of steel or electronics or copper or something. But that would be interesting to see how the tariffs shake out. But I do think that the tariffs may shake out to be a more muted effect than was expected. I wonder if this survey was issued a little bit earlier than maybe it was close to the Berkadia survey as well. But that's just my own thought. Developers also will be focused mostly on data centers, et cetera. So it says special purpose data centers, et cetera. Well, I think they're all thinking about data centers and building those. That's 34% of them. 26% is multifamily though, so not too far behind. And then industrial 20% below that, 9% office, 9% retail, and other 3%.
Does that make sense to you, Matt? Like
No.
I know that there's a lot of, data centers are interesting, and I don't know exactly. So I'm curious about this question. Like, are they interested in like learning more about data centers?
Yeah.
It's not like there's going to be the same amount of data centers that are going to be built as multifamily. Now you could say we need a lot of data centers, but we need multifamily also.
Yeah.
And so to me, the fact that it's larger than multifamily, it shows that, there's a lot of bullishness on data centers. I think that though that it's a very, I understand the absolute, the more than just a trend for data centers, the need for compute. We're going to see a lot of need for energy, energy infrastructure as well. I think that there's a lot of hype, and I just wonder how much of it is hype.
Yeah, I think it captures the imagination
rather than the fundamentals.
Yeah, captures the imagination, and I think that the yeoman's work of building multifamily that may be a little bit more boring than bits and bytes flying at light speed. Well, that's fine.
Yeah. We're talking about, maybe like, maybe hundreds of data centers, more like 100 or so, 150, 200 versus, hundreds of thousands of multifamily units and thousands of multifamily properties. So it's interesting, the difference. Now, again, I think there's a much sexier case or thesis and story to sell around data centers, and that sexy story is probably what's selling a lot of the interest and the investors. But geez,
speaking of sexy stories, they only really seem to be focused on the sexy markets in this Avis and Young report, because
is it like these like sexy little figurines that they're using, these little avatar characters?
Exactly like just like the illustration. But it does,
I want beautiful people on the report. I want the models to be beautiful. I want the figurines to be beautiful.
I want them to be flattened.
And the skinny, very flat.
Yeah, without much nuance.
Stylized.
Yes, exactly.
Cosmopolitan.
I think that this is flattening and kind of erasing a little bit of the details of the multifamily market, because now their take on this is just like a page of coverage that they're giving to multifamily in this report, but they are juxtaposing the oversupplied Sunbelt with an undersupplied gateway markets that they're calling them core markets, and it kind of elides, neglects, overlooks the entire flyover country of the Midwest, and I also think it's kind of overlooking the Northeast as well. It's got San Francisco, Orange County, Los Angeles, East Bay, New York City, Silicon Valley, Chicago, Washington D.C. Those are the core markets that they think where supply has grown and rent has not really done so well. Now I'm sorry. They are expecting more growth in those markets where supply has not grown, and instead, I think that they should have had Midwest markets in here rather than these markets that I just named. Now they're comparing that with the relatively smaller markets, but still oversupplied, like Atlanta, DFW, Phoenix, Denver, Charlotte, Austin. These are the ones where they built a lot and where rent's not growing so well. I think that Miami is a clear outlier here. Again, we are working on a report that also lays this out. Miami's job growth has been so great, and its inventory growth has not gone gangbusters like a place like Austin. So it's actually had a greater balance and is seeing some positive rent growth in the Sun Belt, which is a little bit of a rarity. I just wanted to point this out. The reason why this stuck out to me was because it did seem like a blinkered view of the multifamily market. And this is one of the reasons why I think certain takes on the multifamily market, maybe like this one that says that there's going to be 1% decrease in values. Well, maybe that's just reflective of the Sunbelt markets that we looked in before, or maybe they're just looking at Sunbelt and core markets and they're not really thinking about the Midwest These are just survey respondents. This is not like CoStar or other sources. I just want to point that out that people are fallible, and these are feelings, and they're not they're not necessarily facts. However, the way that they organized this in this Avis and Young report, I just think that it could have been. I would have appreciated some additional markets that better reflect the entirety of the United States rather than just the ones that are maybe hot today, hot yesterday. Yeah. Those are the ones.
Matt, the fact that they have San Francisco, in Silicon Valley, Los Angeles, Orange County, New York City, East. I mean, again, I thought that those were like in the same, MSAs, right? I didn't think Silicon Valley was its own core market.
Yeah.
Who put this thing together? Well, which Bay Area suburb do they live in? They went to Stanford. Well, yeah, Grant, come on, man. Let's be real. I don't know what kind of really cool, fancy friends that you hang out with, but the rest of the country are investing in markets other than these. And it is kind of laughable that I see Silicon Valley in Orange County, and just Chicago representing the entire Midwest, which isn't even a good representation of the Midwest itself. And then, of course, you have Austin and some of the others in DC, but it's a little laughable. So, fine report other than that, but yeah. Come on, Claire.
All right, we can move over to the single family home investment climate. Now we've covered commercial real estate, and we've covered the kind of a little bit of the cloud of uncertainty, less confident that maybe you would expect, even though they're not, in the doldrums. It's not totally doomsday for commercial real estate investment at all, but it's not as good as it could be, and I think that we're seeing a little bit of taste of that, at least according to Realtor.com, in the single-family home market, where it says that investors are selling a record share of homes to cut their losses. They're saying, especially in these 5 states, I'm not as confident in their way they're breaking down the regionality of this. I'm more interested in how they have. They're tracing this trend of the home investors. Spencer, I thought that the investors are buying up all the homes and making everyone else live in them and renting them. I thought that that's what they were doing.
Well, maybe they did.
Well, right now
they already did that, I guess.
Yeah, they already did that. Now
they did it. Yeah. Some investors bought homes, yes, and now they are selling them. It's certainly a non-true statement that. Like some say that investors have come in and bought all of the homes or the vast majority of homes. There's really no data or science to suggest that. Did they have investors increase their allocation to single family assets? Yeah, sure. That really happened after the great financial crisis. Mm-hmm. And they've done it a little bit in recent years as well, but still, owner occupants are the vast majority of the purchasers of single family homes. And again, we could go into a whole conversation of even, whether it's even a good or bad thing that it's investors versus occupants that are buying homes versus renting. Who can even, but the reality is, man, whether it's investors, whether it's single family occupants, mm-hmm. not a big surprise. Who can afford the mortgage? Who can afford the interest rate? Who is excited to, if they do currently own a home, to trade out their 3%? And if you're an investor, it's not as exactly. You thought that you were going to be flipping this house. A lot of investors are in it for a short time horizon, and then that's very short. We're talking less than a year, 3 years is long to a lot of investors. Mm-hmm. And so, if you bought a lot of homes in 2021, 2022, when rates were near zero, maybe you've got a little bit of appreciation. You can get out, you didn't get the big pop that you thought, but it's time to get out and cycle out. And so there's a lot of inventory hitting the market, and that's not the type of seller who cares about, I'm going to be paying a higher interest rate because I'm going to be buying a place to live. Mm-hmm. These investors, they're not living in the house. They can sell it. They don't care as long as there's a buyer on the other end. The problem that we're seeing is there aren't that many buyers. For obvious reasons, it's because of interest rates and uncertainty, but especially interest rates.
Yep. I agree. It says in 2024, just under 11% of all homes sold in the U.S. came from real estate investors, the highest share in the data's history going back to 2001. Investor home sales ticked up 5.2%, outpacing the increase in investor buyer activity. So that's awkwardly worded. What this says is that more investors were selling their homes than were buying them. Investor home sales. So investors were selling their homes more than they were buying their homes. They're dumping them. And this was in 2024, and I don't think things have changed in 2025. This is another thing too that we talked about in the early years. I like to think I'm getting nostalgic for the early years of a Gray
The early days.
Was we looked at single family home investors and how it tracked with home values and the trends in. Basically, I was looking for, all right, the savvy home investor where the home investment picks up when values are low and then they dump them when it's high. When in fact, it seemed like if you take it all by the trend, the share of home investors peaks when the values are high and they really go down when the values are low. It's almost like they're dummies, but they're getting excited when I'm sure that they have different exits and stuff, but it is not exactly, they're not moving the prices at all. And if they are following the prices, they're following it in a way that's like that's not to the detriment. If anything, they're kind of losing money on these things when the prices are low.
Matt, there's an old story. I remember my dad telling me this about his first day in business school, and I think it's one of the last classes he had business school that he actually attended. But he said his professor said on the first day, he said, at the end of class, he said, if you show up, the next class, I'm going to show you the secret how to make $1 million. And they all showed up, and the secret is it's really simple how to make money. You buy low and you sell high. That's it. But if it was that easy, everyone would just do that thing. But it's not very clear when things are low or when things are high. And so it's over exuberance. It's classic investor psychology. It's fear and it's greed at play here. When prices are high, you see people making money. A lot of that's happened in the past. You want to get in on that. The fear of missing out, FOMO kicks in. You jump in, you buy it something because people think that things are never going to stop, and because there's whole industries that are banking on the gravy train continuing to go. Let's just keep this thing rolling as far as we can take it. And then when it's the time to buy, everyone is saying no. There's no money available to even go and buy the things, just like we're seeing right now. And again, this is why I'm excited. You don't see a lot of equity because people are scared right now. And when people are that scared, it's a great time to get in. It's the classic, be greedy when people are fearful, totally. Be fearful when people are greedy. It's kind of a classic example. Now, again, we're coming back to, there's a lot of nuance, right? I mean, not all of these regions, not all of these markets are the same. Certain markets had a ton of the private investors that came in. Some of those markets have held up well, some haven't. If you're looking at Florida as an example for the entire housing market, you're going to make a big mistake because you've got a lot of other factors in Florida or in Texas or in the Gulf states than you do in the East Coast, West Coast, Midwest. So there's a lot of nuance. Sure, there can be some broad trends like interest rates, like capital markets, like tariffs, that type of stuff. But man, it's time to be tactical. It's time to understand exactly your strategy and focus on that and not paint with a too broad of a brush, which unfortunately, when you're putting a report together, it's hard to focus on, one market. And so you're focusing on like that Avison Young piece. Granted, the reason why he selected those markets is because that's where a lot of those readers are. And that's where a lot of his base is. And those are institutional investment markets. There's money in Silicon Valley. There's money in Chicago. There's money in Los Angeles. That's why it's not necessarily have anything to do with which markets are going to be the ones that we should talk about or which markets are going to have the best opportunities. It's literally, we want to get clicks for our reports. So we'll select the markets where our readers are in. Or that they might sort of be interested in.
A lot of this does reflect the kind of dominant investment sentiment, and the way to make a good investment is not necessarily to go with the flow. You have to figure out where the flow is going to go, and that's sometimes that means going out on a limb, but not necessarily. I think it just means kind of uncovering something that people haven't noticed, but that's my own personal thing. If we want to move in just a little bit, if we're talking about locations and markets, I want to talk about this real page blog where it talk occupancy is slumping in major South region markets. This is not surprising to us, but these are also the popular markets that are being covered by Avis and Young, and that are being noted probably by investors that are responding to Berkadia and John Burns investor surveys. The problem is that occupancy in the South is at 94.5%. That is compared to the Northeast, which is at 97.1, and the Midwest and West at 96.5 and 95.8 respectively. This is where they built a lot of apartments, and if this is the only place that you're looking at when you're thinking about multifamily investment, then you're going to think that the investment market is not doing so well. You're going to expect valuations to decrease 6%, like they say in John Burns, or maybe more if all you see is apartments in Charlotte and Austin. I think that there is a case to be made for different regions, but this map here just shows how low the occupancy is. And these numbers are in the mid 90s. They're all in the mid 90s. The skew between 97 at the highest and for the Northeast and 94.8, that's like 2.3%. So it's not like a huge, wait, is it 2.3?
Yeah.
Whatever the math is there. I'm not really great at that. 2.3 seems like
slight spread.
Yeah.
No, I think you're right, Matt. I mean, I think that it's a little bit of a shift. I mean, in a couple of years ago, the Midwest on average had slightly lower occupancy than the Sun Belt. So we have definitely seen a shift over the last several years. And the chief reason is, as we've talked about, it's supply. I mean, absolutely, it is supply. But you made a good point. It's not like the spread is that wide. And I think it does underscore, even in the oversupplied Sun Belt, the amount of demand and absorption that's taking place in those markets is keeping those markets at least afloat. Maybe not with much rent growth and maybe a lot of negative rent growth in these markets, but there's still demand for apartments. It's just they're not able to achieve the rent levels that they would like to see. So, yeah. I mean, I think the South is going to rebound over the next couple of years. It's just when that's going to take place. But just lastly, Matt, again, you made the point of just what we were talking about from the last piece. These are the markets that so many investors flooded into because this was the consensus trade. The population growth flocking into the Smile States, the Sun Belt. It was the sure thing that made a lot of sense. And I mean, again, this map, it's not just, Salt Lake City and Denver. I didn't know that they were in the South. I don't think that they are. They're kind of Mountain West regions. But so you could call these Sun Belt markets.
They call them lifestyle markets.
The lifestyle, yeah, and good. It's the markets that the large investment managers sold to their clients in New York City and California. Mm-hmm. These are the markets that said, look, sit back in New York City, Los Angeles, in your shiny office. Look at all the population growth in the Sun Belt. Let's all make that same trade. Let's all build in the same markets, in the same submarkets. Yeah. Everybody took the same trade and everyone's getting burned because of it. And we're seeing the same thing happen. Again, go back to that Avis and Young piece. Look at this real page report. Yeah. They're highlighting the same markets that the same investors are just focusing on again and again, and they're not getting the nuance or the markets that actually have the opportunity and have shown stability and sustained growth. And then lastly, like we talked about, in a market where there's an incredible amount of uncertainty, focusing on those stable markets that like the Midwest, proven time and time again, that have balanced supply, stable economies, investors with a little bit of nuance and are willing to do a little bit of work, or listen to the Gray report, are going to see those opportunities pretty clearly.
Yep. And it's not just specific markets. There's also this interest. So supply has like driven different market performance, but that's kind of obvious, at least for us. We've been talking about that a lot. What when it comes to Class A versus Class B and C assets, there's something that's developing it's interesting that I haven't really thought very much about, and it is kind of a convergence in occupancy. So this is another Real Page article, and it's with the headline, Class A occupancy recovers, though still trails Class B and C assets. I'm going to skip to the graph here because Class A usually trails B and C assets. Almost always trails B and C assets. I think that the news here is that it's actually the spread between A, B, and C is about as small as it's ever been. And I'm sorry, I'm kind of skipping ahead here, but these lines between Class A, B, and C occupancy, they are very close together. Now they were very close in July of 2024, so mid 25, mid 24, mid 23. It's almost like these past 3 years have seen these super narrow spreads in occupancy. And what's common about these last 3 years is because these are the 3 years where supply has dominated the story of rent growth, occupancy, market performance. Take a pick on whatever metric of multifamily fundamentals that you want to use. These have supply has dominated those, and I wonder how much it has resulted in this spread being so small for 3 years running. To me, that's what it is. It's this narrative that people kind of thought, well, Class A, they're building all the Class A's. What they really need to build is Class B's and C's. And what really happens in the market is Class A's get built, and they have to kind of make some concessions and discount to fill the apartments, and then maybe a Class B unit. Well, now suddenly these people are leaving because the nice apartments are cheap. The nice new apartments almost as cheap as mine, so they're going to upgrade. Well, the Class B is like, all right, now I got to lower my prices. And Class C does the same thing, and it cascaded in a way that is very telling when you look at, well, this is peak leasing season for, arguably. So July of 23, July of 24, probably July of 25 is going to be the same summer where it's the really nice apartments are just as full as the slightly less nice ones. Really, really interesting, I thought. And again, like usually Class A is a percentage point or so. I mean, at the very peak, Class A apartments were about 1% away from Class C. Usually it is Class A is the lowest occupancy, Class B is the second, and then Class C. Right now, Class C has lower occupancy than Class A units, and I just think that it's an interesting development. I think that it does kind of prove that there is some flexibility within these different asset classes, and it shows that there is a different that there's a different trajectory than maybe was expected by some other people. So if you want to pick back up here, got a little sidetracked because looking at the sidebar, they do have Gray Capital cited here. The Gray Report, one of the videos titled, Is the Real Estate Market Getting Worse? Now, I am following Bettridge's Law of Headlines, which says that if the headline poses a question, the answer is usually no. And so just to let you know, we're posing that for sensationalism, and the answer is no. But if you had listened to this,
good headline, Matt. Good title. I guess it worked, Matt. The only thing else I want to say, I guess, a couple of factors. One, just if Class A is always going to be a little bit lower on occupancy, typically, because those are the properties that are being leased up. They start at zero, and so and that's why CoStar breaks out and other sources break out. Stabilized Class A and properties that are in lease up. Because again, if you don't, all of a sudden you'll have a property that again it starts at zero. Take an average, that's pretty low, and it can drop the overall market average occupancy in a way that's really not truly telling the story. But also because of that, so a lot of these properties have been built, they're all been in their lease up period, and a lot of them are now finally stabilized and leased up. So you have properties that were in maybe 70% a couple of months ago, now they're 90% plus occupied. Additionally, again, we talked about it's hard to buy a single family home. Interest rates are up. So what are those individuals that were going to buy a home? What are they going to do? Well, they're going to move into an apartment. What other choice do they have? And are they going to move into a B-class apartment? Probably not. I mean, they had the money to buy a home maybe a couple of years ago, and so they probably want something nice, maybe with a garage. So they're going to look at those Class A properties. And as we've said, because of, A class had to lower their rents, B class were able to kind of match those rents or move down because everything slid down as new supply came on. I mean, I know of some B-class properties that are charging more for a two-bedroom than an A-class property.
Yeah.
And so you're going to see that divergence. Things will settle a little bit over time, but there's a lot of demand right now for nice apartment, and that it's showing up in the data right now.
Yeah, I agree. And I think the other thing that this graph tells us is that occupancy is in general sharply recovering from a bottom, which was around January 2024. So whatever, all three of these classes.
Peak deliveries.
Yeah.
Peak deliveries, right?
Yeah. Yeah. So peak deliveries there. And then it has shot up in about 1.5%. So from basically 94.5% to what is, a full percent, but 95.5% occupancy, which is about where it was pre-pandemic.
Yeah.
So we're at a
we kind of repeated. Yeah,
we're normalizing in a really interesting way, and I think that should spell some relief for people that are burdened by low rent growth, or at least like the landlords and some of these people that have really suffered and struggled to operate apartments these past few years. Maybe with this recovering occupancy, we will start seeing more rent growth. And I'm not sure which one comes first and how that interacts, but I think it is a positive sign for apartment owners and operators going forward. And I also wonder if that will play a factor in sales activity. If equipped with better fundamentals, if owners will be more willing to sell or buyers will be more willing to buy. Certainly, it seems like if the market improves, then people will be more excited to transact. Although, I don't know, interest rates are going to be a big factor for that.
I mean, again, Matt, I can't speak for the Sun Belt. I can talk to you about Indiana, Michigan, Ohio, and some of the Midwestern markets. But I mean, in our portfolio, I mean, we're seeing some really positive trade outs, rent growth. I mean, we've got some sites that are increasing rents 5 to even 10%, a couple that are even higher than 10%, a couple of properties that, are still kind of in that kind of transition period that are, growing closer to 3%, but we're positive across the portfolio. Mm-hmm. Again, but we've got a lot of properties that are 5% plus. And some of the trade outs even have exceeded even that 10% mark. So, wow. I mean, we are seeing that positive momentum, and that is being driven by tighter occupancies in general. So again, that's just a snapshot of the great capital portfolio. But there's a clear trend of increasing occupancy, and we've seen a reversion from the peak of tight occupancy that took place in basically January, February of 2022, and then the trough that we saw in 2024. And that the difference between those, takes 2 years to build apartments. Money was cheap in 21. That's when everyone started building. Mm-hmm. We built them. Went on the market, occupancies drop as there's a lot more units to sell, and those units have been leased up, and we're halfway right between kind of peak and trough. Look at that.
Yeah, that's crazy. And I will say, talking about the Midwest and talking about the performance of our assets, I also, it does seem like that has trickled down to investor sentiment, at least for, kind of Indiana, Midwest assets. There is more investor interest in those, at least from talking with the investor relations team. Like, people want to invest in the Indiana. We just got to get the good deals to give them. But I am not doubtful that there's investor interest for the Midwest specifically. And some of those surveys, I just think that they're focusing on the markets that have not done so well. And this is a point in which there still is this divergence of performance between your Austins and your Kansas Cities or Indianapolises. So this is going to be an interesting time to get some opportunities while the market's still a little bit asleep. I think it's probably going to wake up in the next half of the year if all these survey respondents are correct. And this, I keep thinking back, Spencer, to your metaphor. This may have been a year ago. So it's like, when you're talking about the recovery, are you at the is the clock at the 6 o'clock? Are we at the 5 o'clock and it's going to swing back around? Where are we on the upswing? And if you're thinking that maybe there's a little bit more difficulty to come, finding an asset that's able to survive the bad times and the good is probably incredibly important, especially when, there's so much uncertainty.
Looking for that sure thing. Yeah. Makes a lot of sense. Yeah. Does feel like the clock has been stuck though for a while though. It's like the doomsday clock, 1 minute to midnight. And it's like, it's been 1 minute to midnight for a long time.
Yeah, totally agree. Yeah, so that's all the articles I have. I don't know if I'd like to just remind people that we do also have the Gray Midwest Multifamily Fund that kind of focuses on a lot of these similar markets. And if you'd like to explain a little bit more and something, anything else that Gray Capital has going on, I get scared of what I'm allowed to say and what I'm not allowed to not say. But I just think that we've got some.
That's okay. That's okay. It's not live. No, thanks for bringing it up. I was actually going to ask you about our latest research report that's going to be coming out soon, Matt. But
Yes.
No, the Gray Capital sponsored Midwest Multifamily Fund. We did launch that. It's for accredited investors only, really targeting towards institutions, family offices, registered investment advisors, and we're going to be targeting the Midwestern markets that we have experience in, that we know, markets like Indianapolis, Columbus, Ohio, and some markets in Michigan and Kentucky, but a lot of opportunities. We've got great deal flow. Going to be partnering with a lot of stellar institutions and investors. You can go to graycapitalllc.com/Midwest. Fill out a form, schedule a meeting with the team, and kind of have a conversation, see if it's the right fit. Again, it's only open to accredited investors. There's a higher minimum. It's $1 million minimum. So it's really for kind of, again, institutional investors is who it's intended for, but we are allowing individuals to come in if you can invest at that level. Don't worry though, we will have other opportunities, some direct multifamily syndications for accredited investors with a lower minimum. So if you can't hit that minimum, that $1 million limit, we will still have deals for you to still participate with Gray Capital. But yeah, it's an exciting fund. The fundraiser is going really well so far, and we're going to be spending some time raising that capital before we deploy. We're going to be really deploying in 2026. We're just going, which I think is going to be a great time to be buying multifamily as well. But Matt, again, I that was a teaser for the fund. I know we've got a report that's going to be coming out as well.
Right.
These reports that we've been putting out, these Gray reports, research briefs, we've really ramped up our type of statistical analysis. John Chapman's been on the team, doing some really great some stat work.
Mm-hmm.
A lot of just, again, novel and bespoke research to Gray Capital that no one else is really doing. What is in the queue? I know we were just finalizing it. It's going to go to print soon. What can you say?
Yeah, so we're looking at the relationship between supply and job growth and vacancy, and using that to predict future rent growth and supply. Really predicting the future of multifamily for all these different markets, and also on the national level. What's interesting is that there's a different mix of job growth and supply in every market, and the values of those, the power of that job growth and supply, it's going to vary when you're talking about Austin versus talking about Tampa or Miami. So we've run these projections, and it's not a hard and fast rule for all of this. It took a lot of work for John to figure out what the weights of everything is and how things are all correlated. But I think there's some interesting insights, and one of them is that Miami is still going to do great. I don't think that was ever a question, but because there's just like all these broad brush stuff, all these broad brush things that we say, oh, the Sun Belt's bad. Well, when you look at the individual markets and you do some projections, some of it points to Austin doing a little bit better because the job growth is just so fantastic there. So there's some things right around the corner that we're trying to see in this report, and I think it'll be really interesting what people find out, just as much as I've been kind of fascinated through this few weeks working on it.
I'm excited. One thing that I learned is really the different approach you need to take for different markets. And if you use the same weights for every market applied equally, you're going to get some incorrect or just not the results that are accurate enough. And so a lot of this analysis, again, these are big national firms that are doing this research. They don't necessarily have the time to focus on individual markets and adjust the specific weights for those markets and submarkets. So we're not doing every market across the nation. We're doing in part markets that we think are important, that are worth highlighting, not just in the Midwest. Again, like Matt said, doing Austin, Miami, some of those kind of regional bellwethers or just interesting case studies. But we're taking a focus on, again, some of those Midwestern markets that are important to us, that we focus on, that are often passed over by these national firms. And one of the reasons why they may have been overlooked is because we're not actually doing the statistical analysis correctly. It amazes me, Matt. Again, housing, it makes up a massive part of GDP.
Yeah.
It's 33.4% of CPI, so a major indicator in the economy. But there's very few firms that are actually doing the research in some of these markets accurately. It's a relatively small world. We've had some of the leading housing economists on the Gray Report just over the last several months. And that's because the Gray Report's a great program, it's a great YouTube show and podcast, but we're not the biggest news outlet in the world, and we're getting the biggest and the most prominent housing economists to come to us because it's a small universe. So it's an exciting report. And it's going to be has the most novel research from the Gray Capital team. So props to you, John, and the rest of the team for putting it together. Excited to put it out.
Oh yeah, we'll be talking about it on the Gray Report, I'm sure, next week. So I'm excited.
Yeah, great episode, Matt.
Thank you.
Excited to be back in the saddle next week. Great. And everyone, again, pop over to graycapitalllc.com to learn more. Sign up for the newsletter, get info on the fund, and get in touch with us if you are a accredited investor. So, all right, catch you on the next episode.